If you're one of the roughly 7.5 million Americans who were on the SAVE student loan plan, your monthly payment is about to change, whether you do anything or not. The SAVE plan is gone. A court ruled it unlawful, and as of July 2026, the clock is ticking. Borrowers have about 90 days to pick a new plan, or one gets picked for them. In its place is a brand new option called RAP, the Repayment Assistance Plan. Different payment, different rules, different timeline. So what actually changed? What's RAP, and what does it mean for your monthly payment? Today we break it down, SAVE versus RAP by the numbers with no spin. Let's follow the money. I'm Don Blake, and this is USAFinance, where we hand you everything you need to understand your money with nothing but sourced facts in plain English. Two things before we start. One, this is education, not advice. We'll explain what changed and how each plan works. We will not tell you which one to choose. That depends on your income, your balance, and your goals. And two, this is completely nonpartisan. We don't care who passed what. We only care what it means for your payment. No politics, no outrage, just the mechanics. Every figure comes from the U.S. Department of Education and federal student aid. If this clears things up, subscribe. Let's get into it. Here's the headline. The SAVE plan, that's saving on a valuable education, is over. In early 2026, a federal court entered the judgment that ended it, ruling it went beyond what the law allowed. Then, starting around July 1st, 2026, loan servicers began sending notices to everyone still on SAVE. The message, you have about 90 days to enroll in a different repayment plan. If you don't choose one in time, the department has said you'll be automatically moved to another plan, likely the standard plan, which can mean a much higher monthly bill. So doing nothing is a decision, and usually the most expensive one. The 90-day window is the single most important thing to know. To understand what you're losing, let's be clear about what SAVE did. It was an income-driven plan, meaning your payment was tied to your income, not your balance. For many borrowers, that meant a very low monthly payment, and for some, as low as $0 a month. It also had a generous feature. If your payment didn't cover the interest, the government waived the rest, so your balance didn't grow. For millions of people, SAVE was the most affordable plan they'd ever had. That's exactly why its end matters so much. SAVE also shielded more of your income before payments even started, a bigger cushion than any plan before it. That combination, a low percentage of a smaller number, is what made it so cheap for so many. And it's exactly that combination that's now going away. Whether you thought SAVE was a good policy or not, the fact is simple. For a lot of borrowers, it kept payments low, and now it's gone. So why did it end? Two things happened at once, and we'll keep this strictly factual. First, a series of lawsuits challenged whether the Department of Education had the legal authority to create SAVE. The courts ultimately sided with the challengers, and the plan was struck down. Second, a 2025 federal law reshaped the entire menu of repayment plans going forward. It phased out several older income-driven plans and created a new one to replace them. That's the whole story. Without the shouting, the courts ended SAVE, and a new law redrew the options. Our job isn't to judge it, it's to help you navigate it. Let's talk about that 90-day clock, because it's the part with a real deadline. When your servicer sends your notice, around July 2026, you have roughly 90 days to log in and choose a new repayment plan. For most people, that means acting by about the end of September. If you miss the window, you don't get to keep SAVE, it's gone. Instead, you're automatically placed on another plan, most likely the standard 10-year plan, which spreads your full balance over 10 years and can sharply raise your monthly payment. The takeaway, watch for that notice and don't let it sit. Choosing on purpose almost always beats being assigned by default. So what are your choices now? The menu got shorter. Several older income-driven plans, including SAVE itself, plus Pay and ICR, are being phased out for most borrowers. Going forward, the two main income-driven options are IBR, income-based repayment, which has been around for years, and the brand new plan created by the 2025 law, RAP, the Repayment Assistance Plan. There are also the fixed plans, like the standard and graduated plans, where your payment is based on your balance, not your income. For most people leaving SAVE, the real decision comes down to this: RAP, IBR, or a fixed plan. Today we focus on the new one everyone's asking about, RAP. So what exactly is RAP? The Repayment Assistance Plan is the new income-driven repayment plan, available starting July 1st, 2026. Like SAVE, it ties your monthly payment to your income instead of your balance. But the formula is different, the protections are different, and the timeline is different. The government designed RAP with one headline promise: if you make your full payments on time, your balance won't spiral from unpaid interest, and you'll actually chip away at what you owe. That sounds good, and parts of it genuinely are. But like every plan, it comes with trade-offs. Let's look at exactly how the payment works, then the upside, then the catch. Here's how a RAP payment is calculated. It's based on your adjusted gross income, the income figure from your tax return. The payment scales with what you earn. It starts at a minimum of just $10 a month for the lowest incomes and rises gradually as income rises up to about 10% of your income for higher earners. Then there's a family adjustment. RAP subtracts $50 a month from your payment for each dependent you have. So a parent with 2 kids knocks $100 off the monthly bill. One key difference from SAVE: under RAP, the minimum is $10, not $0. Almost everyone pays at least something each month. Now, the genuinely good parts of RAP, because there are real ones. First, no runaway interest. If your calculated payment doesn't fully cover the interest that month, RAP waives the leftover interest. Your balance won't balloon just because your payment is low. The same protection people liked about SAVE. Second, a principal boost. For borrowers whose payment is small, RAP can add up to $50 a month straight toward your principal, the actual amount you borrowed. That helps you make real progress instead of just treading water. So for someone with a low income and a big balance, RAP is designed to stop the debt from growing, and that's a meaningful protection. Now the catch, because every plan has one, and this is where you need to pay attention. RAP has the longest road to forgiveness of any plan. Any balance still left is only canceled after 30 years of payments. Older income-driven plans forgave the remainder after 20 or 25 years. RAP stretches that to 30, and remember, the minimum payment is $10, not $0. So borrowers who paid nothing under SAVE will now pay at least something every month. So RAP trades a lower risk of a growing balance for a longer time in repayment. Whether that trade is good for you depends entirely on your numbers, which is the whole point of comparing. So let's put them side by side. SAVE versus RAP, the head-to-head. Payment: SAVE could be as low as $0. RAP starts at a $10 minimum and scales up to about 10% of income, minus $50 per dependent. Interest: both protect you. Neither lets unpaid interest balloon your balance. RAP adds a small principal boost on top. Forgiveness: SAVE forgave the remainder in as little as 10 to 25 years. RAP takes 30. The pattern is clear. RAP is often a bit more each month and a longer timeline, but with strong protection against a growing balance. SAVE was cheaper monthly, but it no longer exists. You're choosing among what's left. So who actually comes out ahead under RAP? Let's be specific. RAP tends to help borrowers with lower incomes and larger balances, the people most at risk of watching their loan grow. The interest waiver plus the $50 principal boost means their balance can finally start shrinking instead of climbing. It can also suit someone who wants predictable, income-based payments and isn't counting on fast forgiveness, someone planning to steadily pay down the loan rather than wait it out. If your biggest fear was your balance exploding while you paid what you could, RAP was built to answer exactly that fear. For that borrower, the protection is the whole point. Now the flip side, who might pay more under the new rules? The clearest example, anyone who had a $0 payment under SAVE. Under RAP, the minimum is $10, so a $0 payment isn't on the table anymore. And anyone who was close to forgiveness on an older plan may not love RAP's 30-year timeline. If you were counting on cancellation in 20 or 25 years, a longer clock is a real downside. This is exactly why there's no single right answer. For one borrower, RAP is a lifeline. For another, IBR, or even a fixed plan is the better math. The plan that's best is the one that fits your numbers, not a headline. That brings us to the other big option you shouldn't ignore: IBR, or income-based repayment. IBR isn't new. It's been around for years, it's written into law, and it survived the 2025 changes. Like RAP, it ties your payment to your income. Depending on when you first borrowed, it caps payments at 10 or 15% of your discretionary income and forgives the balance after 20 or 25 years. For some borrowers, especially those closer to forgiveness, IBR's shorter timeline can beat RAP's 30 years. For others, RAP's balance protection wins. The point isn't which one we like, it's that you have more than one choice. So compare them before the clock runs out. Here's one more piece that catches people off guard: taxes on forgiveness. For the last several years, any federal student debt that got canceled was, by a temporary law, free from federal income tax. But that temporary tax break expired at the end of 2025. Unless it's renewed, that means forgiven student loan balances could once again count as taxable income in the year they're canceled, potentially a surprise tax bill down the road. This is complicated, and it can change, so we won't guess your situation situation. Just know the rule shifted, and if you're on a long forgiveness track, it's worth understanding before that day arrives. Check studentaid.gov and a tax professional. Let's zoom out and put the scale in perspective because this isn't a small change. About 7.5 million borrowers were enrolled in SAVE. Every one of them now has to act. Among those still on it recently, the average balance was around $55,000. Step back further, and federal student debt in America totals roughly $1.5 trillion, spread across more than 40 million borrowers. It's one of the largest categories of household debt in the country, behind only mortgages. And all of this is happening as loans move back into active repayment after years of pauses and legal limbo. So millions of people are recalculating their monthly budgets at the very same moment. When the rules change for this many borrowers at once, the stakes are enormous. So when the rules of repayment change, they change life for tens of millions of people at once. That's why getting your own plan right matters so much. So what does all this mean for you, practically? Let's turn it into a way of thinking, not a recommendation. Your monthly payment on any income-driven plan comes down to a few levers: your income, your family size, your balance, and how long until forgiveness. R, AP, IBR, and the fixed plans each pull those levers differently. The right move is to actually run your own numbers on each option before you choose. The department's official loan simulator at studentaid.gov does exactly that, for free. Before you log in, write down 4 numbers: your adjusted gross income, your household size, your total federal balance, and roughly how many years you've already paid. With those 4, the simulator can rank your options in minutes. Nobody can tell you the best plan from a headline, including us, but you can see it clearly in about 15 minutes using your real income and balance. That's the goal. So here are the DOs, general steps that apply no matter which plan you land on. Do log in to studentaid.gov and confirm your loan servicer and your status. That's the official source, and it's free. Do open that 90-day notice the moment it arrives and use the free loan simulator to compare RAP, IBR, and the standard plan on your actual numbers. Do keep your contact info and income certification up to date so your payment is calculated correctly and you don't miss a deadline. And do make a choice on purpose, because if you don't, the system will choose for you, usually at a higher payment. Now the don'ts, and the first one could save you thousands. Don't pay anyone for student loan help or forgiveness. Every official plan, form, and application is free at studentaid.gov. Companies that charge to enroll you are, at best, charging for something you can do yourself, and at worst, a scam. Don't ignore the 90-day notice. Silence gets you auto-enrolled, often on the priciest plan. Don't panic, and don't make a rushed decision based on a scary headline. The plans are complicated, but they're knowable. And don't assume the cheapest monthly payment is automatically best. A longer timeline can cost more over the life of the loan. So here's the bottom line. The SAVE plan is gone, ended by the courts and replaced by a new law. If you were on it, you have about 90 days to choose what's next. The headline replacement is RAP, payments from a $10 minimum up to about 10% of income, minus 50 per dependent, with strong protection against a growing balance. But a 30-year road to forgiveness. IBR and the fixed plans are still on the table too. There's no one right answer. There's only the plan that fits your income, your family, and your balance. The one universal mistake is doing nothing. Log in, compare, and choose before the clock runs out. Let's put it all together. SAVE versus RAP by the numbers. SAVE is over, struck down by the courts. Around 7.5 million borrowers must switch within 90 days or be auto-enrolled, likely on the standard plan. RAP is the new income-driven option, $10 minimum payment, up to about 10% of income, minus $50 per dependent, unpaid interest waived, a possible $50 principal boost, and forgiveness after 30 years. IBR remains an alternative, often with a shorter timeline. Federal student debt, about $1.5 trillion across 40+ million borrowers. And the free tool to compare it all lives at studentaid.gov. Here's the real bottom line. The student loan rules just changed for millions of Americans. The deadline is real, and the worst move is to look away and hope. Now you know the plan menu, the RAP formula, and exactly where to compare your options for free. At USAFinance, that's the mission. Hand you what you need to understand and manage your money. Sourced, nonpartisan, and in plain English, never advice. If this helped, subscribe. It's free, and it's how we keep going. And next time, we go to the root of it all. The everyday money habits backed by the data that quietly keep working Americans broke and how to break them. I'm Don Blake. Make your money work. We'll see you next time.